All right, good morning, everybody. Real quick before we go anywhere, I wanted to start just a minute or two early to mention that Monday the 20th, Option Omega is going to be at the Bullish Bears at 3 o'clock in the afternoon. That is the target, anyways. Now, Monday's a holiday, the markets will be closed, but we're still going to be at the Discord, right? So, 3 o'clock Monday, the owner and developer of Option Omega is going to be there. They're going to give a presentation of their product here. I don't want to get into too much on what their product is, other than it's a back testing product designed for the options marketplace using intraday data down to a 1 minute time frame. They continue to update and upgrade this thing. It doesn't do a lot of markets yet because their focus at first was working on features. Now they're adding more products. Just yesterday, they added the Qs and IWM. So now it's got SPX, SPY, QQQ, IWM, and it'll continue to grow from there. But this thing is a game changer if you understand how to use it and then you apply it to known or existing strategies, iron condors, butterflies, calendars, blah, blah, blah. So don't miss out. They'll also be offering a massive discount on their product. So, yeah, just wanted to start a little early, mention this. Once he introduces it, going forward after that, we will be rebuilding all of my old mechanical strategies that we've had to shelf since COVID, right? Because my mechanical systems were built on a marketplace that we're no longer in. And this being unprecedented market conditions, we don't have anything to, uh, we didn't have any way to figure out how those old mechanical systems would work in a market like this. But now we have this tool. And I've already fixed one, which is my mechanical weekly iron condor. Yep, that's back. But we'll also be able to do the other 17 strategies that we used to do. And rather than rebuilding them on my own, and then trying to make videos explaining to you guys how they work, I will be rebuilding them live in the afternoons in the Bullish Bears, doing, like midday or afternoon live streams, putting these things back together, benchmarking them, testing them, figuring out what we can do to get them back into play. It'll be presented on June 20 at 3 o'clock in the afternoon in the Bullish Bears Stock and Options channel. All right, so we'll go ahead and get started. Like we usually do, we want to take a look at what happened in the overnight hours. There is like a global bond crisis going on right now. The rally that we got after FOMC barely lasted into the close. Once we got up into the open, the bond markets around the world, central bankers hitting surprise rate numbers around the world. Add to that some issues with Bitcoin, and the market rolled right back over and continued to go lower. I gotta say, I'm a little disappointed. I wanted to be able to short this sucker, so I wanted at least one day where we came up off of the lows before going lower. But you know, we're still, as I will show with the charts, we're still up off of the lows when we think about how far away from the 10 we are, right? We did half that distance. So, if we can just hold the line here and let that 10 get caught up a little bit more, we'll be able to size up and short this sucker. So nothing really extreme, right? When we come in here and we look, we're looking for anything really extreme that might affect global markets, say like a boat stuck in a canal, right? That was something that rocked the world, that kind of came out of the blue. Most of the time, you're not going to see anything that drastic, right? We don't go day to day looking for that kind of stuff or finding that kind of stuff. We definitely want to look. We have a lot of things on the agenda, but they're all done by noon. One thing that surprised me is there's no Fed speakers today. They've been silent as they always do before the FOMC announcement, but we're past that now. I kind of figured at least one of them was itching to chip their teeth, but nah, not yet. Right now, guys, though, it is all the bonds and oil, energy. That's that's the main ball of wick, as they say. All right, so let's bring it over to Thinkorswim. We go to Market Watch. We bring up this tab. I always bring this tab up because if you're trying to look back on your intraday, say a month from now, and you're trying to figure out what happened on June 16th, was there a Fed day? Was there economic events? What was the intraday? You'll be able to bring up this recording, and within the first 5 minutes or so, you'll be able to see this screen. This helps you try to figure out what was happening that day. And we've been doing these morning briefings this way, 9 months or more, the public ones anyways. So you're able to go back quite a ways. And this allows you to help identify what was happening on that day. Midday reversals, for an example, are kind of my forte. They're my thing, catching midday reversals. And I often catch them because of these additional auctions here at 11, 11:30, and sometimes there's a 1 o'clock, but there is not one today. So be aware of these additional auctions. They are game changers. Can't tell you how many times the market completely reversed course right at 11 o'clock or right at 11:30 when we had these additional auctions. I call them additional auctions, kind of based on the idea that the market is an auction. It's what it is, right? You had two people, you put those two people together, a transaction took place. It's an auction. Maybe an antiquated notion, but these would be, quote, an additional auction, right? A little play on words. It's something that I've done for a long time. They're just auctions. The gas report normally would be something we wouldn't pay too much attention to, but they're in a little bit of a squeeze, figuratively and literally. They're like cranking the valve and squeezing the flow to Europe. So there could be a little bit of reaction in the market over the gas report. Not expecting too much. Just don't sleep on it, right? It's 10:30. Be ready. You see something happening in the market, just keep in mind, oh yeah, there's a gas report there today. So 8:30, 10:30, 11, 11:30, and we should be done on the other side of that. So for once we get past noon, whatever we get for the rest of the day should be it. This is an indicator that I built a while back based on the logic that the 10-period daily moving average is very similar to the center of a basketball court or a football field. Everything starts in the middle. Price does not like to get too far away from that 10-period moving average before it will stall, pause, stop, and give the market time to catch up with that 10, or it will reverse course and move back towards that 10. Well, every market has its own distance, its own average distance from the 10, where it will get to some point and stop and or reverse. Well, since every market is different, I actually wanted to find a way to put that into numbers and quantify how far away is too far, so that when we see big moves in the market, we're able to put some numbers behind it. Have we gone too far too fast? Are we too far away from that 10? And what should we expect? The other day, we got 6% away from the 10-period daily moving average in the S&P. We're no longer at that 6% because the market paused, right? If we zoom in here a little bit and look at it in some detail, the market paused and has been going sideways, kind of building out this little micro megaphone pattern. Either way, it quit advancing to the downside and it held the line waiting for the 10-period moving average to get caught up. It even came up a little bit yesterday, right? We had that slight rally yesterday. So we were no longer at 6%, but that 6% is now the benchmark. Before that, 4%, 4.5 was around the benchmark. In the last 2 years, for an example, the ES has never gone 6% away from the 10 period moving average until now, right? In history, I'm sure it has. We're just looking at the last 2 years. So at this point, are we too far away from that 10? Not anymore. No, we've pulled back, we've paused, we've consolidated. The market could easily continue a move to the downside from this point because we are not too far away from the 10. Quote, too far. There is another number though that's just as important. It's not just the 10-day, it's the 10-week. Now, if you've kind of nerded out on moving averages before, you may have noticed that the 10-week and a 50 period daily moving average are pretty close together. They're not synonymous, they're not perfect, but they're very close together. Investors Business Daily really uses the 10-week a lot. It's in a lot of their theories, a lot of their analysis. It's what they really lean into. In the last 2 years, the market has never been this far away from its 10 period moving average on the weekly time frame than it is right now. So from that point of view, we really expect this market to pause and consolidate and wait. Wait for the market to get caught up with that 10 or to go back towards the 10 to kind of mean revert. And that does kind of follow the logic that it's been a pretty significant sell-off and we're maintaining the range and everybody was kind of looking for a lot of information. Right now, it's the July numbers. The one thing the market did not like yesterday was this, how he implied yesterday that they're just automatically going to lean into a 75 for July. The market doesn't want any kind of language that says that they're running on autopilot. Any phrase or any hint that they're going to just automatically do something without looking at the numbers is going to upset the market. And that seems to be a part of what we're seeing this morning. That's not my opinion. I read that in the Bloomberg 5 Things You Need to Know. And I've also read it on Thinkorswim this morning with its little morning briefings that Thinkorswim does, right? So that's the consensus view of what is happening this morning, not my view of what's happening this morning. All right, let's bring it in and look at how far we have traveled. We are down 2.25% today. The red and the orange lines on my screen here are the ADR. You can see that we are outside the expected move for the week. We also hit the edges of the average daily range, the ADR. Now, the ADR that I use is based on where we closed, most likely at 4 o'clock. And their distance traveled is leaning into the close at 5 o'clock, right? It's always been a little bit of a debate when you're looking at a daily chart. Where was the close from yesterday? How far away from that close are we right now? 2.28. That matches up here, 2.28. But if you were to go in and look at where that close was, is that the 5 o'clock close or the 4 o'clock close? Right, and the 4 o'clock close, really, it's not that far off this time, right? Normally, it's a lot farther away than that. Always know your broker. Know where they're putting their benchmark or their data, especially on Thinkorswim and especially on a Monday morning. All right, so we're at the edges already. Kind of asked the question, where are we going to go from here? Well, we do want to check, is there a market maker move? No. Okay, well, at least we looked. My label should have already told us if there was a market maker move, but we don't trust Thinkorswim to do anything. So we always want to validate to make sure, is there a market maker move in the S&P this morning? Not on the ES anyways. The next thing would be for Friday, what is the current expected move? Now, when it comes to this, honestly, rather than trying to use the futures, you're much better off just looking at the SPX and asking what the expected move is for Friday. right? Or do it on Tasty. Tasty shows you the futures better with the actual dates on there. Before the FOMC, the expected move was getting bigger and bigger and bigger instead of smaller the way it was supposed to. But now that we are done with the FOMC, this should be our Friday 58.44 for the rest of the week. Now, this is a dynamic expected move, not the static one that we always use. But no market maker move, and we've already traveled our ADR. So what do we do at this point? Like we've done in the past, you want to take that ADR, cut it in half, and add it to the current ADR. If you're a little bit of a nerd like me, just get the old calculator out. Where'd my calculator go? Sorry, we'll use the machine. 1.45. That would get us a move of 4.36. That would be the next level down. I got that pretty close. Close enough. So that's taking the ADR and adding half of it, which gets us one step closer. Beyond that, we would want a full ADR, right? So we've already got a 2.91. That would be 5.82%. So if things were to get extreme today, remember the ADR is normal, that wouldn't be extreme, right? And now we're moving into what would be extreme. Not sure what you mean by a public briefing and a private briefing. So that's our downside move for extreme. There's really no reason to mark an upside extreme at this point. If we travel from the low and go all the way to the high, we would basically just be moving an entire 2.91%, right? We'd have to travel through all of that. Is it possible that we broke through the top and could make a run to the upside? I mean, yeah, it's totally possible, but is it likely? Not really likely, right? So what we want to focus on at this point is, where are we in relation to yesterday? We are outside of the expected move. So we have an inside day breakout at this point. It's very likely that we judge against the bottom of the box and maintain this structure or go lower. We're going to be looking for anything in the job numbers to kind of solidify this negative market behavior and then aim towards these lower targets. Now, should everything start to turn around and just not stay negative, which is different than being positive, then the idea would be that we would anticipate a move back inside the box. That's really inside day or no inside day. That's really what it's going to come down to, right? Are we going to make it back into that box or not? If we do, the size of that box is very big, right? It's a very large day from yesterday, 120 points. So if we were to get back inside that box, there's plenty of room to run around in there. The best thing to do at that point would be to mark out your pivot points, open, high, low, close from yesterday, including the high of the Globex and the low of the Globex, which would add additional pivot points to work with. Don't forget to mark the open of the RTH, the regular trading session, as one of those pivot points. You would be surprised at how amazingly accurate and helpful these pivot points are. And it doesn't require any special coding or skill. You can literally just go out to a daily chart most of the time and mark those levels down. Yesterday's high, low, and close. If we are to make contact with any of these pivot points today, there is very likely going to be a response in the market. We don't approach it from the idea that price is supposed to stop there. These are not support and resistance levels. It doesn't owe you anything when price gets there. Watch the dome, right? Watch the tape, watch the dome, look at how price approaches the level, have an idea of what are you going to do with the trade when it gets there. I've had people ask, well, what do you do? Just put the order on the dome? Not me, no. And think about where the liquidity is at. If we were to revisit, say, our own Globex low this morning, where would the liquidity be? Well, it wouldn't be right there on that line. If you're looking at the dome, there is very likely liquidity on the other side of it, right? That's where the orders would be, on the dome. So if you put your order in to go long right at the pivot point, you're very likely going to get run over because it's going to go through your pivot point to the other side to where the liquidity is at. It makes perfect sense, right? Want to look a little farther out, or a little farther down, I suppose, is another way to say it. The size of the volume profile this morning. So I didn't know that there was any disagreement about what liquidity is, but it would be orders on the dome, right? That's not my definition of liquidity. That is liquidity. Are there participants? Are there orders on the dome? The only silly question is a question not asked. The volume profile this morning is very large, and it's basically because of the move that we just made, right? This is a 10-day, 30-minute. The point of control is way over our head, and we are outside of the box. Now, the running thesis is when we're outside of the box, that we get back inside the box, right? So when that's our bias and that's our expectation, we want to look at what price is doing and ask the question, are we continuing to move farther away from the box, or are we moving back towards the box? Well, at the moment, we're moving farther away from the box. The volume profile ends at the 10-day, and there is a significant level of volume over our head, which doesn't really concern us right now if we're going to continue to move to the downside. We just want to note and recognize how unusual it is that a market would be outside of the profile and continue to expand farther away in that profile, right? That's why we even bring it up and look at it. Where are we compared to where the profile is? And then what are we doing at this point, moving back towards it or continuing to move away from it? Consider it like the dominant thesis versus what we're getting, right? Or how do they say it? When what should happen doesn't, I guess is a good way to say it. This is liquidity. Now I'm on the micro NASDAQ, and so it's single digits, not very much, not very large. And if I look at the flow, I can see that there are transactions. If we were to swap that over and say something a little more liquid, you see there's double digits and even perhaps triple digits. See all of these orders that expand a long ways down. Liquidity. for questions like that, always ask, right? Because you don't know if you don't ask. But don't be scared to ask Google either. Google is really good at a lot of questions. We don't have any volume profiles to carry forward from the previous days. Doesn't hurt to look. We come in and we take a look. None of these previous profiles offer an untouched point of control that we could bring forward. So we looked, there's nothing there. It's fine. We move on. We've basically got our range for the day and our bias for the day. It would be very likely that we maintain the range and then we come back up inside of yesterday's price action. That is the most dominant thesis. Now, we can continue to go lower from here. Absolutely. Yes, we can. So I don't want to imply that we can't, but we want to ask, what's the more likely scenario? Plan for the more likely scenario. And then if it starts to do something other than that, then we realize that we're dealing with a market that's doing what it shouldn't do, right? Or what most people didn't expect it to do. Some of the biggest moves that we ever see come from traders being on the wrong side of the market. So if everybody expects that we're going to go back up into yesterday's price and then we don't do that, how many of those are caught off sides? How many of those longs would have to sell to get out, right? We'd be squeezing them as we move lower. Their selling adds to the selling, and we just get these extreme exaggerated moves. One thing of note, we haven't really gone much lower. If we're looking for the next leg down, that ain't very much. Continue to keep your eyes on all of these indexes, and I've heard from a number of you who say, I don't have all the screens that you have. I can't look at these all day long like you can. I get that. If you don't have very many screens, you can save these things, right? You build them, you save them, and then when you're on your Think or Swim, rather than trying to rebuild your chart every time, you have it saved so you can just go in and look at that one chart, right? Just like this setup here, I have this on an alternate screen. I don't have to continue to rebuild it every day, and it's not a floating detached chart that bogs down my machine. And from here, I can just bring up whatever it is that I want to bring up and look at. So you don't have to have those up every single moment. If you don't have the screens, right? I mean, if you got at least one extra screen, it would certainly help. But having those detached windows, they do sort of bog down your machine. Like if I was to just detach this one and detach another one and another one, another one, you get 5 or 6 or 7 of those things floating around and you really bog down your machine. It sucks, right? So at least this way, you're just cycling through those. And once you get used to it, maybe you name them a particular way. You can use asterisks or percentages or even dollar signs to make the names that you put in here go to the very top. Notice the very first one in my list has a number in front of it. 4 horse. H would not belong in this, right? It'd be like way down here somewhere, except I put a number in front of it. It moved it to the top of the list. So get a little creative with your naming system. Have the ones that you want to cycle through right at the top of the list so you don't have to hunt through all of those to find it, and then just cycle through them. That way you don't have all of those detached windows and you can cycle through the charts that you want to see. Or, and this is one thing that I really like about Think or Swim, you have these 4 grids across the top here: pairs trader, active trader, futures trader, and Forex trader. Well, I don't trade pairs here. I don't trade active trader here. So I went in there and I set them up for what I wanted to use them for, and then I saved them. Every time I want to look at my 9 grid sectors, for an example, I always come to this screen, the pairs trader. I don't have to come in and rebuild it or set it up or bring it out of a saved menu system. It's just right there all the time. Every once in a while, Thinkorswim will knock that off, and then since it's saved, I just put it back in again. My active trader screen is always this year to date with an anchored VWAP and the weekly expected move. I know it's there. It's always there. I just go to it. It saves me from having to go and bring up another chart, pull it out of the menu, blah, blah, blah. It's just right there, right? Short, sweet, fast, in a hurry. You just bounce through from one to the next, to the next, to the next. Something to consider for those of you who've reached out and mentioned that you don't have the extra monitors. So there you go, right? Oh, yeah. Dying, you make a good point. I did say that. So these morning briefings were what I was doing in my own private coaching community. And every once in a while, I would do it in public for the rest of the bullish bears. And the feedback was, we want more of that. So I brought it out of my private coaching community and put it into the bullish bears on a day to day basis. The morning briefings were actually designed to teach people how to do their own pre-market work. Um, I know it seems like I'm giving everybody a fish, but the goal actually was to teach people to fish. It goes hand in hand with this video right here, trend days and how to capitalize on them. I don't name these. A lot of times, Lucian would name the videos that we make. This video was designed to help people do the morning briefing and have that checklist and to go through that list and then the cycle through it through the day. And that didn't really gain any traction. And most people said, I don't understand what the hell you're talking about in there. Okay, I mean, I get it. So we had to back up. If that was too, I don't want to say advanced, but just too complex, it wasn't doing the job. And I thought, well, what would work? How do I teach people how to get ready for the day? Just do it every day. Do it live, so you guys can see what I look at every day, and that it would help you develop your own way of doing it. Right? I don't want to think that everybody's out there just trying to do what I do for a morning briefing, but you could at least pick up on the steps, the details, and then develop your own morning briefing. All right, I did mention natural gas. We do have that this morning. We're also seeing it up significantly. It's the most moved thing to the upside this morning. Looking at what's down the most, semiconductors, energy, which is a little odd this morning. I am looking for new longs, so I'm absolutely happy to see the energy is down a little bit. It was kind of getting a little ahead of its skis, right? It's not quite how you would say it, but it was getting up there and we needed a pullback. We needed this thing to slow down and offer us an opportunity to get in. We've got a long ways to go in this marketplace, right? We're looking at least 12 to 18 months before we really start to turn this ship around, and energy is going to be a large part of that. But nobody wants to participate in a runaway market, or at least, I mean, if you're already in it, yeah, I'm sure you're loving it. But for the rest of us who had already taken profits, it hasn't offered us a chance to get back in again. Now it is. We're finally getting a reasonably decent pullback. And there's a little bit of logic that kind of goes into that, a little behind the scenes of the move yesterday in the S&P, let's see if I can read it the way it would make sense. Either oil spikes with the US dollar in yields, or it pauses while the market corrects lower. If the market stabilizes and grinds higher, like yesterday, then we would be betting on an oil spike to stop that move higher, right? Because they are not going to let the S&P rally back up to all-time highs. Any rally in the marketplace is going to get beat back down. And how are they going to do that? Well, they would use the energy products to do that. But we didn't see the spike, right? So the S&P rolled over and stopped that move higher, and they did not have to bring energy out to do it. Of course, they didn't have to, because bonds and the central bankers from around the world beat that sucker down on their own last night. So yeah, there you go. Just watch for that, right? It's not just that we want to find energy as a way to trade, or that it is the only upward moving sector out there on a consistent basis right now. It's also one of the products or the tools that they're going to use to beat this market down and continue to punish all those dip buyers out there until people quit buying the dip. So seeing the market down 3%, I kind of like this. I'm going to be looking for any reversal in energy, a rally off of the lows, just reclaiming the 3% that we are down would be a nice move on the day. That'd be a great day trade. Energy and finance has been my day trade go-to products. It's not ending anytime soon. And then if we were to actually go positive on the day, then we're talking about reclaiming the 3% that we're down and then actually getting another maybe 1% to the upside. That'd be a really nice move on the day. Emerging markets, this is our risk on, risk off gauge for global sentiment. Obviously, the global sentiment is what killed our rally last night. This is very likely going to stay negative through the morning. Watch for it to turn around, though. If you start seeing the emerging market turn around, then there's a little bit of sentiment shift out there. You can tie in with EEM, the junk, and HYG, right? Corporate bond yields, things like that. We're not looking at them as a tradable opportunity, more as a gauge or a tool of sentiment. Pretty much everything is down this morning, right? I mean, there are just very slightly a few names out there, like real estate, mid caps, gas. Yeah, and I've got videos on this, guys. So um, all of these concepts for the Thinkorswim, I completely reset my Thinkorswim and I built it out again from scratch. It took 10 videos to do it, nice and short and easy. So if you're on the Bullish Bears Discord and you go to after hours, you go to the pin up at the top, I've got these 10 videos, top down charting, setting up your Thinkorswim in a line, right? I just reset mine and went through it step by step. But if you look at the trade tab and you go to all products, what you end up with are pairs trader, forex, active trader. You get these 4 charts, right? And they're just tabs. They're just ready to go. You don't have to pull them out of the menu system, right? So if you go to active trader, yours might look like a normal, that would be a normal active trader. Or if you go to pairs trade, yours might look like this junk. Well, if you know you're not going to use that, right? If you know that you're not going to use this tab as a pairs trader tab, why not use this space for something that you do want to see? I use it for my sectors, right? So then I just go in here and I already have a chart saved. I put my sectors back into place and then we're good to go. That's not my sectors. There we go. That's a fun question, Chris. That is a very fun question. There is, say, a little bit of tinfoil hat to a lot of that, but the plunge protection team is a real thing. And how can they control the market? Well, if a voting Fed member goes on Fox News like they did when we first hit that 20% bear market territory a few weeks ago, and they come out and start talking about positive monetary policy and they spark a rally in the market that rips us to the upside, that's how they can control the market. They didn't have to go out and buy anything. They didn't have to turn an algo on. They didn't have to wink and nod and do some behind the scenes shakedown of a bank. All they had to do was go out and discuss monetary positive policy and to see the market move to the upside. And if they don't want it to go up, but instead want it to go down, then they can go out and do that too. Right. So that's just one example out of many of ways that they can manipulate the market or control the market. Don't think that it has to be somebody sitting there buying or selling or trading something. You are. You absolutely are. Um, if you go to Google Scholar, not just Google, but Google Scholar, type that in, you can get research and white papers and reports from around the world and all these different fields of inquiry. And they keep track of how much the algos are trading in today's world or what their belief is on what the algos are trading in this world. So great research papers where they really dig down into the question of who are you trading against? If you go to Google Scholar, you can basically Google anything just like you normally could, only the results that you get won't be advertisements and junk. You're going to get results based on um, industries and colleges and research and their peer reviewed white papers, right? So, really great way to dig deeper and get information. We've hit every topic I wanted to hit this morning, guys. Be very careful. Continue to think about after lunch today, we have nothing on the books, right? So if we get through the morning, we get into lunch, start looking for the end of lunch to be the signal for what we're going to do this afternoon and how we're going to do it. And keep in mind that we have every expectation of staying inside the box, right? And that is a very large box that we could travel through, and it would just be inside day. All it needs to do is get in the box, stay in the box, and get through the rest of the day. It doesn't owe us anything. So if we do break down, it is very likely going to get really ugly really fast, right? We've already marked out the levels and discussed it, and we just play each benchmark, right? You get to that goal, and you look at where the next goal is, measure out the what's more likely, look for your opportunity, and play it to the next level.